In today's video, we'll take a look at a very easy way to confirm false breakouts. Now today we had the FOMC event that took place, and with the FOMC event, we of course had a good deal of volatility. Now the first step, I think, in confirming false breakouts is knowing levels at which you expect price reversals to take place. I think context is everything, and that's where the volatility boxes give us that crucial piece of volatility information. So here inside of the ES futures, so the S&P 500, I've loaded on our doomsday conservative models. That means we're on our most conservative, our most cautious models that we have available to us. And there we're looking for price action to give us signs of a reversal. Now that's what these clouds are, but if I start by first removing these clouds, we click apply, this should hopefully make the breakout a little easier to see that took place during the FOMC event. We had price action that created a mini range here with the FOMC event. This is the post FOMC statement volatility. We had this range, which was a fairly wide range that presented itself in the S&P, about a 44-point range. Now the S&P tried to break above it, and if you look at smaller time frame charts here, for example, if I come into a 1-minute time frame chart, this breakout looks like it's actually going to be a move to the upside. We have price action close above this level right here, the 4065 level, and we even have the next candle, which looks like a pretty decisive close above that level. So very little hesitation. If I come into something like a 2-minute time frame chart here, and we take a look at that same little range here that we were just discussing, the 2-minute candle looks even stronger. I think this candle is the one that fools most traders into the idea that, hey, price action is breaking out to the long side here. We'd like to participate given that it looks like buyers are in control. Now, the reason why we know that this level may not necessarily hold is as a result of the volatility box models. So there, price action tells us, at least in the S&P 500, that we're now approaching our doomsday conservative volatility box levels, and we've even tagged the sign entry line. Now, this is typical of our FOMC volatility, where we break outside of the scalper, the aggressive, the doomsday aggressive, and even the conservative, and we finally end up on the doomsday conservative models. There we see price action breaches the sign line that tells us that, hey, we're looking for signs of a potential reversal. The next few candles, we see an overbought confirmation here with the edge signal confirmation. And there, that gives you the confirmation that, hey, price action's starting to stabilize here just a little bit, and even starting to show signs of weakening, starting to show signs of a reversal. Now, on a 1-minute time frame chart, that first edge signal confirmation came with this big red candle right here, and this candle was the 11:53 a.m. candle. So definitely towards the edge of an hour. This is by far a very aggressive trade, but my goal here is to show you a very easy way to confirm this idea that, hey, momentum is shifting. So here we have a false breakout that's taken place. We see that breakout on a 1-minute and on a 2-minute time frame chart. We know that we've now breached our upper edge of the volatility box on our most conservative volatility box models. We're now looking for signs that, hey, this move is starting to stagnate, and we're looking for this move to reverse. That's where this very simple indicator, which is a dot here, comes into play, and that's our momentum cross. If I show you the code of it, it's a very, very simple indicator. It's the 3 EMA crossing either above or below the 8 EMA, and all that's telling you is that, hey, price action, based off of what we've been doing for the past 3 bars compared to the past 8 bars, is now starting to do something a little bit different. Now, depending on the time frame you use, so in this case, a 1-minute time frame, you'll see more false signals compared to less false signals. So if we look at this momentum cross, the first momentum cross, which is this pink dot right here, took place on that very same candle where we also had our overbought confirmation printing out. And this is on a 1-minute time frame chart. For those of you trading the FOMC, I think you need to be on something like a 1-minute in order to catch some of these moves. On the 2-minute time frame chart, which I think is a little bit better than the 1-minute in that it gives you less false signals, I find it to be a little easier to trade compared to the 1-minute, especially during these periods of high volatility. You have an overbought confirmation along with the momentum cross on the next 2-minute bar. Now that next 2-minute bar in the 2-minute time frame chart is the 11:54 a.m. Pacific bar. So this is exactly 1 minute after the 1-minute signal printed. One more time here, we see that, hey, the 3-period exponential moving average is now doing something different compared to the 8-period exponential moving average. The trend is shifting here just a little bit. Now, the reason I say these volatility models are key and context is key is we need to know where we're coming from. If you take a look at all of this price action here in the middle, you can see we have 1, 2, 3, 4, 5, and 6 different momentum crosses, meaning 6 different times that the 3-period is crossing either above or below the 8-period exponential moving average. It's only after we're crossing our key levels that this momentum cross holds a little bit more weight, where we know that, hey, we're now coming from a level where we typically expect to see reversals taking place from anyways. We're now starting to see, say in this case, an overbought signal that's then followed with the momentum cross, both on a 2 and a 1-minute time frame chart. That gives this idea a little bit more weight. After that, you can see the move that takes place here. We have some nice flush moves down lower with very little heat involved. In fact, we just keep making lower lows, lower highs all the way throughout. Momentum here has very clearly shifted once that 3-period exponential moving average has now crossed below the 8-period exponential moving average. So a very, very simple indicator, a very simple way, the momentum cross, to find periods in which that momentum is starting to shift. Again, the key here is keeping in mind the context in terms of where we are coming from and where that momentum is likely to shift anyways, and we now use this as an additional confirmation. Again, for something like the FOMC, you may need to use a 1-minute time frame chart in order to get the entry price that makes sense from a risk to reward standpoint. But outside of that, I think this notion of confirming false breakouts with something as simple as this 3 and the 8 EMA is a very tangible idea that you can use in your everyday trading, even for days in which we don't have FOMC volatility. I'll conclude this video with the 5-minute time frame chart, in which we can see that we had price action again give us a false breakout, and here the 5-minute chart I think also gives us an interesting piece of information that the closing price of this candle in which the breakout took place could not really break above the high of this range that we had created between that 11 to call it 11:30 range before Powell actually came to the mic. On the 5-minute chart, we can see here that price failed to close even above the breakout range that we made between that 11 to 11:30 a.m. range, which again adds to this idea that this is a false breakout. The 5-minute candle, a higher time frame chart, holds a little bit more weight, unable to close above the breakout range. If we zoom into the 1 and the 2-minute chart, we can see even that 3 and the 8 EMA crossing, which tells you that, hey, momentum is likely to shift, and you have an opportunity to take advantage of this move in a way that the risk to reward makes sense. For those of you trading this volatile period, I hope you found this video to be useful. Again, a very simple indicator. I'll leave a link to download it for free in the description box below, but I hope you find it useful in your trading as a nice way to confirm some of these false breakout signals. Take care, everyone. Good luck trading, and I'll see you in our next update.